Emergency alert, the system is quickly breaking. Martin North, John Adams in the Interest of People. John, hello.
Hello.
Very important conversation this, and things are happening much quicker than we expected.
Indeed. We are here on our public holiday, so today's the Queen's birthday, and rather than actually enjoying our time off, we thought it's quite important that we come into the studio and give our audience a very urgent alert about what has happened over the weekend. So if we just cast our mind to last week, the shock across Australia was the RBA decision to lift rates by 0.5%. And what are the implications for mortgage borrowers? And we covered that in our last post. And a lot of people were obviously quite stressful about, and they're stressing about that situation. Things have moved dramatically faster over the last 3 days. And so particularly our Friday night here in Australia, which is the Friday US time, the inflation data came out in the US, and that has really broke the system. I mean, we've seen some very dramatic events over the last few days, both in terms of things that have happened in the market, but also things that are being expected to happen this week as the US Federal Reserve meets on their Wednesday, our Thursday. And so, just like you said, there's a point in time where governments and central banks will have to decide as to do they save the bubble or do they stop inflation? And this whole decision about the pivot. Now, I think in some of our previous posts, New Zealand was talking about the second half of next year. So were the Americans. It seems to me that after Friday, this decision is perhaps it could be within 3 months, or it could be even a few weeks away. And so the timetable has dramatically shrunk, which means that the implications for Australians and the Australian economy is much more rapid.
And it's very concerning because, of course, the thought was, well, maybe inflation has peaked in the US, right? And therefore they've got time to sort of, but it didn't peak. It's actually gone in the wrong direction. And now all the markets reacted dramatically to that. And we're also seeing the reduction in liquidity in the financial system. And the lack of liquidity is really the thing that the central banks now will be fighting on one hand, right? So liquidity on one hand, inflation and interest rates on the other hand, they're being pulled in two directions now. And actually, whichever way they go, they've got a problem.
Indeed. So what you just said, Martin, is what our audience needs to understand, is that the Americans were running a monstrous lie for months and said that last month inflation had peaked, and that with their quarter point rise in March, 0.5% increase in May, we've seen the worst of the inflation, and now things are going to start tapering off. Well, both in terms of headline inflation, it came out at 1% for the month as opposed to 0.7% expectation, or 8.6% for year on year as opposed to the expectation of 8.3. And in terms of core CPI, which means that you take out food and energy, the month came in at 0.6, and the year on year came at 6%. Which were, again, above expectation. So food and energy are really driving the numbers higher, but even if you take those out, it is still above where the market thought it was going to be. And so it's clear now that the Americans don't have inflation under control, and that's going to put more pressure on the US Federal Reserve to try to be more aggressive in terms of Thursday. And so there's an expectation that they're going to raise rates 0.5%. Given that, and we're going to go through this in a second about what the market reaction was on Friday. Given how the market reacted, there's a lot of chatter over the weekend that they will have to move 0.75 or if not a full 1% on Thursday. And given that the Reserve Bank of Australia tends to copy central banks around the world, obviously we've foreshadowed that, for example, Westpac has said that the RBA is going to raise rates by 0.5% on the 5th of July. given the dramatic events of Friday, the RBA may be forced to be more aggressive if the Americans be more aggressive on Thursday, and that for Australian borrowers will be a bigger shock than the shock of what they thought of happened last week.
Yeah, and the tempo is upping. The size of the lifts will be more significant, but the fallout more broadly into, for example, the housing market in the US is utterly profound because the mortgage rates now have gone through the roof in the US as well.
Yes, indeed. Now the other thing just to highlight for our audience was that, so we had the inflation data come out on Friday night. So what happened on Thursday night, Australian time, was that the ECB met and the European Union decided that they announced that rates were going to go up in July and September by 0.25%, and that they were going to stop quantitative easing. Now, that's also had a dramatic effect in terms of the European market as well, and we're going to get into that in a second. So we're seeing this whole exercise of we're going to fight inflation. Now, so far, that fight has not been successful, and that's why the markets have reacted violently. And now the question becomes is, as the timeline shrinks, are they serious about fighting inflation, which means it's the Harry Dent, the biggest depression in world history, or are they going to surrender that fight? And we're going to see runaway inflation, and we're going to see big problems in both the bond market and the stock market. So just to go, Martin, to what happened with this market reaction. So let's just put slide 1 on the screen. Now, when we think about what happened from about mid-April after Easter through to May, when there was a fall in the stock market, there was obviously concerns about inflation in late April, May. There was a rise in interest rates around the world. And what happened was you had a traditional type of relationship where investors went to bonds, investors went to gold, investors went to cash. So these are defensive assets. And what sold off sharply was shares, cryptocurrencies, and broader commodities, excluding gold. Now, what happened on Friday was that relationship, which has been happening for many, many years, that you have particularly around this inverse relationship between shares and bonds. Usually, if you're selling off shares, you buy bonds, and that's what they call risk off. Or if you're going risk on, you sell bonds and you go into shares. Well, what happened on Friday was that shares and bonds both sold off, cryptocurrencies sold off, but where did the money go? It went into commodities, it went into gold, it went into cash. And so this is a set of market relationships which hasn't been seen for probably 50 years. The last time we saw these types of relationship was in terms of the 1970s. But when you have stagflation and the market is concerned about what inflation is going to do to your capital value, well, you basically don't stay in fixed income or you don't stay in bonds because the real value of your capital is shrinking. So you sell that off, and then obviously the reason why shares sold off was because people are concerned that the American government or the US Federal Reserve are going to raise rates more aggressively, and they obviously were liquidating their share portfolio, and they're looking, well, where do we go that is safe in an inflationary environment where interest rates are going to go up? So some went to cash, and that's probably you play around people concerned about a falling share market with rising interest rates, and then obviously people concerned about inflation went into commodities and gold, and that's why gold and silver and other commodities rallied on Friday. So we're seeing a very set of unique market relationships that is quite fascinating. And if we just go to slide 2, Martin, is that so? This is a graph I saw on Twitter over the weekend, which was quite fascinating, and it just shows that for the last almost a decade, gold and global bonds have worked in a very similar fashion. So when the market is defensive, money will go into gold and they'll go into bonds. And obviously, when markets would like to take on more risks, that they'll go out of gold and bonds and they'll go into shares and cryptocurrencies and other risky assets. But what's happened over the last few months is that you've seen this massive structural break between the relationship between gold and bonds, and bonds have fallen in price as the yields have surged, but gold hasn't gone with it. It has stayed up. And so we're seeing now a fundamental break in these relationships, and that's obviously going to have huge impacts in financial flows as we go forward.
Absolutely. And it also really starts to then question some of the assumptions that people are making with regard to the way markets work and the way that markets are going to work. And I come back to this liquidity issue, John, because clearly liquidity is now a big issue, particularly in some of the bond markets. I think this is something that people need to be very, very conscious of, right? We are in very, very uncharted territories here.
Indeed. So just to explain to our audience, now there's, as people start to look at the financial news and understand what does all this mean for me, I think the key way to explain this, Martin, is that our viewers need to understand three types of risks that are happening in the market. One is what I would let's put slide 3 on the screen. So I would flag out inflation risk or interest rate risk. So the risk that inflation is rising and inflation expectations are rising, and that interest rates would need to go up to combat that. And that's obviously why we saw bonds sell off on Friday. Now we have the issue of credit risk, where basically an entity can't meet their debt obligations, and there's a default. And then we have an issue which is similar but slightly different, which is about what you're talking about in terms of liquidity risk. So basically, when people don't have enough cash liquidity risk is two things. It's either a market doesn't have enough liquidity for it to function in an orderly fashion. So, for example, during the global financial crisis, when banks stopped trusting each other, the overnight lending market broke down, and there was not enough money being lent, and that's why you basically had the wholesale credit market freezing. Obviously, when we think about 2019 in a previous show where we covered about the repo market blowing up, again, there was a lack of liquidity. There was a lack of money being, people were wanting to borrow money. There was a lack of money being made available, and that's why you saw within a 24-hour period, I think in September 2019, the repo rate went sky high. And so this liquidity issue is that if companies don't have the ability to turn assets into cash very quickly, or if markets can't access cash very quickly, then they freeze, and then the price has to adjust in a dramatic fashion, whether it's a mortgage rate, debt rate, etc., so that you can actually attract cash. And those dramatic moves can have hugely disruptive effects. And typically, what you see, Martin, is that when you have an issue with liquidity, and you see a market freeze up, well then if someone has to dramatically change the amount of interest they have to pay because an interest rate has gone up sky high in a very short amount of time, a liquidity risk can turn into a credit risk. And so that's why they're slightly different, but liquidity and credit risk, they are quite interrelated.
Yeah, and just to give you a sort of a sense, John, if you think there are a lot of corporates out there who borrowed in the bonds market at very low rates, and those bonds are now maturing, and they're having to come back into the market, and essentially they're having to actually issue bonds with much higher coupons because of the higher interest rates, right? So the costs of their funding is rising. That's one reason why we're now seeing less bonds actually being issued at the moment, simply because the fact is that the costs of getting money has gone up. Now, those corporates, of course, are now getting squeezed because, of course, they've still got to roll those cheap bonds off. They're not necessarily actually replacing them with new ones. And that's a classic squeeze that we're seeing now. And the same, of course, with other forms of credit, because other forms of credit are going up. Look at, even lending from the banks. That's going up to corporates as well as to individuals. So we're in a very different scenario now. We've had a decade of ultra cheap money, in fact, getting cheaper and cheaper and cheaper. That's all now reversed.
Yes. Now, how do we think about these risks coming together? Now, it's been true of the 1970s, and I think it's true of Australia in terms of the 1991 recession. So some economists are saying that if you're going to beat inflation, your cash rate has to go above the inflation rate. So think about, for example, the Americans just reported a year-on-year inflation figure of 8.6. So now some people are talking about a 75 basis point or a 1% increase on Thursday. Thursday Australian time, Wednesday US time. Some people say that's not enough to combat inflation. To really get on top of inflation, interest rates have to go at the cash rate level 10 to 12%. So you basically have to go where no one has really gone before in the history of modern finance, and really go aggressive. Now, in the case of Australia, so our latest inflation figure is 5.1. Now, the difference between Australia and the US is US reports CPI every month. Australia reports CPI every 3 months. So the next time we get an inflation number, it's going to be way higher than 5.1. And it could be, now I think the former RBA Governor Ian Macfarlane last week thought that it could peak at 8% Australian inflation. Now, if we were to beat Australian inflation, the RBA would have to go with a cash rate at about 10%. And so the last time we saw a cash rate of that level was in the 1991 recession. Now, if you had a cash rate of 10% in Australia, mortgage rates would be 12 to 14%. And that would basically,
good night, Vienna.
absolutely. So people are being stressed now with potential mortgage rates of going about 4 to 5%. If they went to 12%, it literally would be good night. 1892 depression, the banks the banks in Australia would be completely destroyed. So you have this yin and yang effect. So if you dramatically raise these interest rates to address inflation, at the same time you're doing quantitative easing. So the raising the interest rates raises the credit risk, and the quantitative easing, where you're basically selling bonds on your balance sheet and taking money out of the market, that's creating your liquidity risk. And so we've been told that they're fighting inflation. And as they roll out this program, liquidity risk and credit risk is rising. And now we're seeing some dramatic issues around liquidity. And then so there'll be a critical moment in which policymakers will have to say, what's more important? Do we fight inflation, and that will result in... So just so people are clear, we're not being dramatic here. If we have a liquidity risk event, that's financial crisis. That's 2008 all over again. And because the debt is much more bigger than where we are now, it could be perhaps like 1929 or 1892, a full-on collapse of the share market or collapse of the banks. So that's what happens if you allow liquidity risk to get out of control, and that then leads into a massive default of debt. That's what's going to happen. So that's if you tackle inflation. But if you say we're not going to allow the markets to collapse, we're not going to let the banks go, then you have to surrender to inflation. And if you surrender to inflation, that's when you're basically going to see dramatic impacts in the financial markets. Basically, money being flowing out of bonds into commodities. Commodities will rage, and then you'll start to see huge impacts in terms of. People are sort of being upset now with $12 lettuce. If you have really dramatic raising inflation, society across Australia, but also across the world, will be something we haven't seen in terms of modern times. Now, I'm not saying we're going to be at 1923 German hyperinflation levels, but we will be we'll be heading much rapidly in that sort of direction if we don't get on top of this.
Yeah, and just to give people a real sense, there was an article in the Illawarra Mercury that was looking at the costs of food in the Illawarra over the last 3 months. And they actually highlighted the fact, John, that the cost of food had gone up by more than 20%. That's basic food in 3 months.
Yes.
Right? So already we know that our real inflation rate is way higher than the official number. Right?
Yes.
And those on lower incomes have greater exposure to everyday food costs and those sorts of things as a proportion of their total income. So those people on lower incomes are already feeling much stronger inflation. So this is a real critical issue.
Yes. So one of the important things, Martin, is that just to go into the European context. So when we start to think of, well, we have this inflation problem, and we have supposed tightening coming from the ECB. Well, we're already seeing dramatic impacts in the Italian bond market. So why don't we just put this up now? So we've just seen in the last few months that the yields on the 10-year Italian bond has started to surge, and we know that Italy is one of the most indebted countries in terms of the European Union. So if these bond rates, these yields, the interest rate that the Italian government has to pay on their bonds, if that continues to go up, well, then they're going to have a problem in not only paying back the principal, which the Italians probably have no intention of paying back. They're going to have a problem in terms of meeting their interest repayments, and that is leading to a dramatic increase in terms of in terms of their credit risk.
Yeah, absolutely. And the feedback, loops on that are worth thinking about, right? Because if one area within the euro starts wobbling like that, it's going to be contagion through the eurozone, right?
Yes.
Because actually the eurozone is probably where a lot of the pressures are, and of course it happens to be coinciding with the war in Ukraine as well. So they've already got significant issues there, and this is just another example of how things are interconnected.
Yes. Now, because of the inflation report that came out on Friday, the risk of a US recession has gone up quite dramatically. So let's actually put up this article from CNBC, and the title is "Strong Inflation, Anxious Consumers Add Up to More Worries That Recession Has Already Arrived." So now, one of the key things to talk about this US recession, Martin, is that we did a show back in 2019 where we talked about the inverted yield curve, and why we just put that thumbnail up. So we actually go through the history of this relationship between the 1 and the 10-year bond yield. Now, there has been an inversion over the weekend between the 5-year and the 30-year bonds, but the 1 to 10 has not inverted yet. So now, once that inverts, based on history going back to the 1960s, and a recession can happen within 3 to 27 months. So dare I say that if we see a dramatic increase in interest rates on Thursday, Australian time, we're going to see this yield curve change quite a bit. And obviously with rising rates, with US consumers, but also government heavily in debt, that's going to bring on the recession in terms of a lot faster. Now, there are obviously a lot of concerns in the US at the moment, is particularly in terms of consumer confidence. Consumer confidence has never been lower, according to a number of, in terms of measures. And obviously the Biden administration is completely on the nose politically, with the lowest approval ratings in terms of US presidential history, in terms of where Biden is up to in his stage of his administration. But yeah, so what we're looking for in terms of the US recession coming on, we're seeing this 1 to 10 year yield being inverted, and that hasn't happened yet. But obviously, raising rates, that's going to dramatically slow the economy. That's going to dramatically cut the flow of credit into the US economy, and we could start to. Now, there were some people suggesting that. So we've had a 1 quarter of negative growth this year in the US. Some people think that we would have the recession now, but I don't think that's going to happen, given that the yield curve hasn't inverted. Some people are thinking that the recession was going to happen next year or the year after. I think we could see potentially starting in quarter 3. I think quarter 2 will come out positive growth. I think quarter 3 and quarter 4 could potentially be, could be negative growth, and particularly as we see these rising rates, we're going to start to see all the talk about the US quickly heading into recession, and that's a recession at the same time that inflation is not under control, and that's obviously why, back in 2020 I was calling out the risk of stagflation, and it looks like that scenario is, even though I thought that process started to a large extent in Australia a couple of years ago, it's really coming to a more visible stage in the next few months.
Yeah, and just on this consumer thing, in the US, of course, 2/3 of economic activity is directly driven by consumer purchases, right? And what's interesting about that is that the consumer confidence now, according to the Michigan survey, which came out at the end of last week, is it's as low as it's been for years and years and years. And the mystery at the moment is why consumers are still spending. Now, I think they're still spending because of all of the handouts that they had and the savings that they made through COVID. But they're running down those savings, and they're actually looking as though that's turning quite quickly. And certainly in the Michigan survey now, the forward indicators in terms of buying stuff into the future has really dropped as well. So there are all the seeds here for the consumer to lead the economy into a recession.
Yes, and so one of the big concerns about the US going into recession, it makes the likelihood of a default of some nature, whether it's households, whether it's corporates, whether it's state government, local government, or the federal government, it raises that credit risk. So recession is in terms of it has a credit aspect about it. Now, the other obviously big news that came over the weekend is this issue of liquidity risk. And so Michael Burry, who was the famous character in The Big Short, who basically he saw the U.S. Subprime mortgage crisis happening well in advance of everyone else, and he bet big on that with credit default swaps and made a lot of money for his clients. Well, he just put out this tweet, and you just did a video about it on DFA in the last 24 hours. So let's just put this on the screen. Basically, he says the CPI's news this morning was so awful that it changed the bond market's view of Fed trajectory, and the weakest sector broke. In bond jargon, MBS went no bid, no buys for mortgage-backed securities. So that's obviously a situation where now, to be accurate, this issue of no bid, it didn't, it only happened for a brief moment. But these things typically don't happen. Typically, in these types of markets, you generally have a lot of money coming in to actually buy these securities. So when you have a situation where people are starting to get scared and they're not willing to buy bonds or mortgage-backed securities at any price, that obviously raises the concern that you're seeing a complete breakdown in terms of these particular markets.
Yeah, and of course the mortgage rate went up to 6% for the 30-year, which is as high as it's been for a long, long time in the US. And a lot of people, of course, have already got rates lower locked in, but any new loans are now at 6%. And the problem here, of course, is that we've also got the Fed, who's going to be reducing its holdings of mortgage-backed securities because they use that through the quantitative easing program.
Yes. So in March, the US Federal Reserve announced that they were stopping quantitative easing, and their QE program was a combination of buying US Treasuries and mortgage-backed securities. And then so in May, they basically said that they were going to start quantitative tightening, and they were going to start it actually technically this week, in terms of this week coming. So that even though they said it was going to commence from June, in terms of these maturing bonds and these mortgage-backed securities, they're actually maturing halfway through June, which is this week coming. So what did they announce? They said that in terms of securities, they would allow the first 30 billion to basically be sold as the first 30 billion is matured. They'll allow that to go into the market, which will basically expand the supply of bonds and drive up rates. And anything beyond 30 billion, they will reinvest. And for mortgage-backed securities, they said the first 17.5 billion they will allow to go into the market, and then they will reinvest. But this is only a 3-month window, and then in the next 3 months, they are supposedly supposed to raise these caps from 30 billion to 60 billion for treasuries, and from 17.5 billion to 35 billion in terms of mortgage-backed securities. So basically, we have a situation in the mortgage-backed security market is that we have an issue with people wanting to buy these bonds at any price, at the same time that the US Federal Reserve is saying they're going to sell their bonds, these mortgage-backed securities, into the market. So if they're going to sell more into a market where no one wants to buy them, what's going to happen to that market? You could see so this liquidity issue could result in a default credit risk issue, and then obviously if that were to happen, mortgage-backed securities would basically blow up the entire financial system because it would start to spread, and interest rates right across mortgages would start to go sky high, and then you'd have huge unraveling in terms of the financial system. So that's why your post last night and our conversation about this now is really important, because supposedly we have markets that are not functioning, and they're supposed to be putting more of these bonds into the market. And it's like, well, who's going to buy them? Because if there's no buyers, then prices go sky high. I mean, what does that mean for everyday mortgages? It's going to go through the roof very quickly.
Yeah, and the point, of course, is that it will definitely dent housing in the US. So house prices in the US have grown quite strongly. It's sort of easing back a little bit now. So the expectation is that this will also put downward pressure on house prices, right? And one of the questions that I posed in that post that I made yesterday was, well, the Fed might be okay to allow financial markets to ease down a bit, but will they really allow house prices to drop down, and how much? And it's another front, if you like, in this whole economic conundrum that we've actually got at the moment.
The other point that is really important to highlight, Martin, and perhaps you didn't sort of crystallize the point in your show last night, is that if you have US mortgage-backed securities blowing up, and you have the cost of credit in the wholesale market going higher, that's not just an American problem.
Yep.
This is an international market. And obviously, one of the things that we've highlighted in terms of one of our previous shows about quantitative tightening, next year and the year after. So obviously, Australian banks are heavily reliant on the international credit market, but to add fuel to the fire, next year and the year after, they're supposed to be repaying 188 billion of this term funding facility and going to the international credit market to actually get capital to finance all of the in terms of their loan book. So we could start to see that if the US mortgage-backed security market goes up and the cost of international wholesale credit goes up as well because the system is freezing, that could have a dramatic impact already in terms of Australian banks, in terms of whatever funding they need from these markets. And obviously, if the Australian banks are paying more for credit, they will pass those on to consumers independent of the RBA. And then and that could be happening in the next weeks or months in 2022. And then we have this issue of them basically paying back over the next 2 years 188 billion, and then obviously having to borrow even more credit at more expensive rates than 0.1%, which will again mean that the Australian banks will have to push more and more interest rate rises out of cycle onto mortgage holders who are sitting on I found this quite fascinating that Alan Kohler, and you've covered this in a DFA show, where he said that Australian property versus GDP is bigger than the Japanese bubble, and the Japanese bubble was one of the biggest bubbles in recorded finance history.
Absolutely. We have ourselves a really interesting bubble here now. I mean, it is a bubble, I think, structurally developed, structurally created, and the point you're making about these higher interest rates, it's also worth reflecting that 60% of the bank's funds now are actually from deposits, mostly term deposits and some cash call deposits. They're going to have to put those rates up to be able to try and attract some of that funds. But they've also still got between 12 and 15% of short-term international funding in their balance sheets at the moment, right? And that's being rolled over every 90 days or so.
Yes.
Right? Those rates are going up. That means that whatever they do, they're going to be faced with higher funding costs as well as paying back the TFF. So the only way that mortgage rates can go in Australia is up. And that could be independent of what the Reserve Bank does with its own rising of rates.
Just to recap about what we've said in the last few weeks, and again, I won't speak for you, but I'll speak for me. I believe that when this moment in time comes, and it could be this week, it could be in the next couple of months, there will be this critical juncture of which risk is more important? Do we fight inflation and we risk a credit default, or we risk a liquidity market event happening, or do we say we're not going to allow the banks and the markets to freeze and we're going to let inflation go? Now, importantly, one central bank has already given up on the fight of inflation, and that is actually Japan.
Yep.
Now, Japan's interesting because it's actually a very different economic structure compared to Australia. So whereas Australia is a net borrower in terms of our foreign debt, Japan, and also is the United States, and in terms of say the United Kingdom. In terms of Japan is a net lender. So while they have the biggest government debt in the developed world at more than 260% in terms of GDP, but they have some buffers and cushions because they are not reliant on international credit markets to be able to fund in terms of all this government debt. But now while inflation is going up, inflation has been ridiculously low in Japan, and so inflation is now sitting at 2.1%, which is above the 2% mark for the Bank of Japan's inflation targeting, and it is expected to go up. Now, if the Bank of Japan was to end quantitative easing and they were to raise interest rates in Japan, that would put dramatic pressure, funding pressure on the Japanese government to basically fund all of these trillions of dollars in terms of Japanese government debt, and so you could see a default risk in terms of the Japanese government. And so that's why the Bank of Japan has basically said, we're not concerned about inflation, even though inflation is rising. We're not going to fight inflation. Everything's fine. We're going to continue along our path of super cheap money with this QE program and with these ridiculously low rates. And so because they have so far to date given up the fight, or not even have they given up, they're not willing to fight inflation at all. The Japanese yen has gone through the floor. In order to highlight the point, so why don't we just put this article on the screen? We have an article from one of the Japanese news agencies, and the title of the article is "Monetary Tightening Not Suitable at All," Bank of Japan Chief Kuroda says. And so basically, again, so now they're basically saying not only behind the scenes but quite openly, we're not going to even fight inflation because we don't think it is a big issue. And so once you start to look at, well, what has happened to the Japanese yen? So if we go onto our next slide, we can see that the yen versus the US dollar. So as the US government, the US Federal Reserve is raising interest rates dramatically, and the Japanese are refusing to do anything with their monetary policy, the yen is falling quite heavily. And we've seen this over the last 12 months, that particularly in the last 6 months, the Japanese yen is falling. But also when you look at what's happening in terms of the yen versus gold, and so we got that slide as well. We're seeing that again, the yen is quickly losing value. So now, if we see this worldwide, that the central banks basically surrender to inflation, just like the Japanese have, well, then you're going to see all of our currencies versus real commodities, whether it's gold or silver or oil or wheat or whatever, they're all going to fall in value. These prices are going to go higher, and those commodities will obviously, drive a cyclical round of inflation, and it will become quite persistent, and then you get inflation expectations rising as well. So we have this inflationary cycle that happened in the 1970s, and it feeds on each other, and now we're seeing that process starting to happen in Japan. And obviously the question and the concern in Western economies is that, are we going to allow that inflationary death spiral to happen in our economy, or can we get on top of that issue? Now, and obviously in some of our previous shows, we've talked about a neutral rate, or Philip Lowe's talked about a neutral rate of 2.5%. Now, again, 2.5% cash rate, even if it's above 3 to 4%, as E. McFarlane says, that's going to be horrendous for Australian mortgage holders. But even at that level, can they get on top of inflation? Economic history says that interest rate is too low, and they really have to go well beyond what the financial system and the banks can actually take.
Yeah, so they are really absolutely caught now. And I guess, John, the overhang of debt, just the total amount of debt in the system, is a big part of the problem here, isn't it? Because the magnifying effect, because of the quantum of the debt, means that even small increments in interest rates have huge impacts on real people and real businesses and real governments, right? Because we're just so highly leveraged.
Yeah. So to bring the show to a conclusion, Martin, is that the monstrous lie in the US run by the Americans that inflation had peaked, that narrative collapsed on Friday. The financial markets have acted violently in terms of that, and now we have pressure on the US Federal Reserve this Thursday to dramatically raise interest rates to get on top of inflation. And by doing so, and by implementing quantitative tightening, they are risking, either a credit risk event or a liquidity risk event that could blow up into a financial crisis and into the Harry Dent deflationary Armageddon. And so at some point in the next 90 days, again, so it may be longer, but I think it's in the next 90 days, this decision of, do we go deflation, crash? Do we go inflation and protect the financial system from implosion? That decision is going to come very, very quickly. And once that decision is made, you're going to see some very dramatic implications in the financial system. And that will then flow through to economic life, and both here in Australia and around the world, in terms of how ordinary people live their lives. And while you just said food inflation here in the Illawarra has increased by 20%, obviously, if we start to see commodity prices go sky high across the world on these, whether it's wheat or corn or whatever, we could start to see food prices go a lot higher, and the basic necessities, either they'll be out of reach for the ordinary citizen because they're too high in price, or you'll have shortages because you're not able to produce enough.
Yeah, it is looking very precarious, isn't it, John? And I think this decision from the Fed this week will be a really, really critical signal as to where it's going, right? So we'll be perhaps talking about that later in the week. But I agree with you. I think by September, we'll actually know where this is going to land and which way it's going to play out. And I think either route looks pretty uncomfortable.
Indeed.
Martin North, John Adams, Interested People. We'll see you next time.